Welcome. Most traders study chart patterns, indicators, and reversal candlesticks, searching for the perfect signal. They look for the causes of market movement where they don't exist. Chart patterns are just the result. The price of a financial asset moves because of an imbalance between supply and demand at any given second. In this lesson, we'll break down how exchanges work, explore order matching mechanisms, and understand who truly drives major trends. Subscribe to the channel. Let's jump right in. The core of exchange trading is the matching engine. It's the exchange's computer system that matches orders between market participants. All orders enter the order book, creating a queue. Orders fall into two main categories: limit orders and market orders. Without understanding the difference between them, it's impossible to grasp price action mechanics. Limit orders represent passive demand or supply. A trader specifies the exact price at which they are willing to execute a trade in the future. For example, buying an asset at $60,000. That order simply waits its turn in line.
Trade global markets with spreads from 0 pips and forget about overnight position rollover fees. The swap-free service is designed for long-term strategies and active scalping. All net profit remains in your account. With InstaForex, your trading capital always works at peak efficiency.
Limit orders build liquidity. The more limit orders at a specific price level, the higher the asset's liquidity. Traders see clusters of limit orders on charts as support and resistance levels. Passive orders have one key characteristic: they do not move price. They sit still and act as a barrier. Price will only move once that limit barrier is fully filled or canceled. In short, limit orders hold back price movement. Market orders are the driving force behind the market. A market order is an instruction to execute a trade immediately at the best available current price. When a trader hits the market buy button, their order is instantly matched with the nearest sell limit order in the order book. Market orders reflect trader aggression. They consume liquidity from the system. Price moves upward only when market buyers completely absorb all the limit sell orders at the current level.
Making mistakes in the financial markets is no longer frightening. The unique risk insurance program allows you to fully protect your deposit. In the event of losing trades, the company compensates for losses. Secure trading and 100% protection begin with an InstaForex account. Follow the link.
Price movement is a continuous process of consuming liquidity. Imagine an order book where there's a limit sell order for 10 coins at $100 and another 10 coins at $101. If a buyer comes to the market with a market order for 15 coins, they buy the first 10 coins at $100. The remaining 5 coins are executed at $101. The asset's price jumps to $101. This process is called order matching. The chart moves forward by chewing through limit barriers. Market participants are divided into 3 main groups: retail investors, market makers, and institutional funds. Retail traders are individuals trading smaller accounts. Their capital is scattered and their actions are fragmented. A single trader with a $5,000 account cannot affect stock quotes. Even when thousands of retail traders execute trades simultaneously, their orders often pull in opposite directions, canceling out their overall impact on the order book. The crowd does not create trends.
No time for routine work and deep chart study? Earn from the experience of professionals. The automated Forex copy and PAMM services let you copy top traders' positions. Your funds remain fully protected. Open an account with InstaForex to invest and trade like a pro.
The second participant is the market maker. This is a major financial institution with a contractual agreement with the exchange. A market maker is obligated to maintain continuous bid and ask limit orders in the order book. This provides liquidity so any participant can execute a trade at any moment. Market makers profit from the spread, the difference between the buy and sell price. They don't drive trends, instead they dampen excess volatility, acting as a market buffer. The primary drivers of major trends are institutional investors, hedge funds, investment banks, and pension funds. These entities manage hundreds of millions or even billions of dollars. When a fund decides to buy a massive block of shares, it runs straight into a liquidity constraint. An institutional player cannot simply drop a single $50 million market order into the exchange. An order that size would wipe out the order book, skyrocket the price, and result in an unprofitable average execution price.
Trading is not just charts, it is a lifestyle. Fund your account with at least $333 within a month and claim premium gadgets, crypto bonuses, or luxury cars. InstaForex offers the market's best prize terms for this.
To build a position, institutional players rely on algorithmic orders. Specialized software automatically slices a massive order into thousands of smaller chunks. The algorithm sends these smaller pieces to the exchange at set time intervals or based on current trading volume. As a result, the large buyer absorbs available sell orders gradually over days or even weeks. During this phase, price often moves sideways, creating an accumulation zone until available supply dries up. Another way to conceal large volume is through iceberg orders. An iceberg is an order where only a tiny fraction is visible in the order book. For instance, a fund might be buying 100,000 shares, but only 1,000 shares are visible in the depth of market. As soon as sellers fill that 1,000, the algorithm instantly replenishes it with another 1,000 from the hidden reserve. The price stays put, but a dense wall appears at that level, absorbing all selling pressure. This is a clear footprint of a large passive buyer.
How to multiply profit with minimal investment. Use a unique deposit format that multiplies your capital on a progressive scale and flexible leverage of up to 1 to 5,000 for large trades. All these growth tools are available only on the InstaForex platform.
Trends don't just accelerate because of incoming new buyers, but also due to forced liquidations from the opposing side. This process is known as a stop-loss cascade or liquidation run. A stop-loss for a short position is actually a market buy order. When price rises and breaks through key resistance, it triggers thousands of these stop-loss orders. A flood of market buy orders surges into the order book, rapidly consuming sell limit orders and causing an explosive price breakout. Institutional players know exactly where retail stop-losses pool. These liquidity pools sit right beyond obvious chart extremes, highs and lows. A fund needs this liquidity to enter or exit massive positions without heavy slippage. An institutional algorithm will push price beyond these levels to trigger retail stops. Retail traders are stopped out at a loss, handing their assets over to the big player. On the chart, this manifests as a false breakout.
Profit from Bitcoin and altcoin volatility 24/7 without complex wallets or buying the coins themselves. The CFD format with leverage allows you to profit from both strong rallies and price declines. You can trade this trending instrument around the clock with InstaForex.
There's a common misconception that economic news directly determines price direction. News releases, like inflation or unemployment reports, are merely catalysts for activity. The numbers themselves don't move the chart. News shifts market expectations. When data deviates from forecasts, institutional algorithms quickly rearrange limit orders, canceling or pulling them to different levels. Liquidity thins out. leaving a hollow order book where even small market orders cause sharp price spikes. To see true market mechanics, professionals use specialized order flow tools. Standard candlestick charts hide what's really happening under the hood. Pro traders analyze volume profiles, footprint charts, and cumulative volume delta. A footprint chart lets you look inside each candle to see the exact number of executed market buys and sells at every price level. This helps pinpoint exactly where an institutional player absorbed price with a limit wall.
Protect your money from inflation and crises. Precious metals are a classic tool for capital preservation. Investors choose gold and silver contracts with instant order execution. Click the link below the video and test metal trading with InstaForex.
Cumulative delta displays the net difference between market buy and market sell orders over a specific time frame. Using delta, traders spot market divergences. If cumulative delta spikes upward, signaling heavy aggressive buying, while price stays flat or drifts down, it reveals a massive limit seller absorbing all that buying pressure. Once buyers run out of steam and demand dries up, the price turns downward. The market isn't a random dance of lines, it's a precise mathematical order-matching process. Price moves only when market orders overcome limit resistance. To trade profitably and consistently, stop blindly searching for chart patterns. Learn to identify institutional interest zones, track hidden volume, and trade alongside smart money. Let us know in the comments. Do you analyze volume profiles and order books? Hit the like button if this breakdown helped you understand the real mechanics behind price action. Don't forget to subscribe. We share actionable, fluff-free trading tools. See you in the next video.